Welcome to Get Rich Education. I'm your host, Keith Weinhold. Once upon a time, if you lived in a house, you probably owned it. If you lived in an apartment, then you were a renter. That has changed with the maturity of the single-family rental space, and the demand for single-family rentals now often outstrips supply. You're going to learn how you can be profitable in this space today on Get Rich Education. Countless property investors get killed with maintenance costs, but that's far less likely when you buy brand new construction. Let me tell you about JWB Real Estate Capital in Jacksonville, Florida. They pioneered the build-to-rent model where you can invest in new construction turnkey rental properties. That's why JWB was featured on the front page of the Wall Street Journal. To learn more and see inventory, go to newconstructionturnkey.com. Finally, Total Control Financial gives you checkbook control of your 401k and IRA money to invest in real estate. It's time to get your retirement money into your own checking account, but you've got to avoid the little-known tax that you'll pay with any self-directed IRA. Instead, it's time for the QRP. Learn more and get your free copy of the QRP book by text messaging QRP in all capital letters to 72,000.
You're listening to the show that has created more financial freedom than nearly any show in the world. This is Get Rich Education.
Hey, you're inside Get Rich Education. I'm your host, Keith Weinhold, and I'm so grateful that you're here for another wealth building week. But as always, you're not here for me, you're here for you. There are probably dozens of advantages today that single-family rental homes have over apartment buildings for you as an investor. Let's talk about some of those, because many of these are things that you've probably never thought about before. And please understand that this is in no way some indictment on apartment buildings. Apartment buildings are great too. They've got great economies of scale efficiencies. And with what you can do with value add apartments, awesome stuff there for sure. I own both types myself, single family and apartments. But there is a reason that some years ago, Warren Buffett famously told CNBC that he would buy up a couple 100,000 single family homes if it were practical to do so. Let's look at why investing in single-family rentals can often be more profitable for you than investing in apartments. It really starts with tenant quality. Single families attract a better quality of tenant. Then there's appreciation. These properties appreciate better over time. Neighborhood. Your property tends to be in a better neighborhood. And then there's a school district. You're likely to be in a better school district with single-family rentals. Retention is a huge one. Tenants tend to stay longer because single-family homes feel like their own. In apartments, more frequent vacancy and turnover and make-ready expenses are an underestimated killer for apartment investors. Better neighborhoods and school districts also help aid in that retention. What about common areas? There are no common areas to clean and maintain. With single families, apartments have hallways, stairs, and laundry rooms that a custodian must service, and that servicing is often another overlooked profit drag that apartment investors miss in their profit and loss statement. In single-family rentals, tenants often pay all of their utilities as well, and they even care for the lawn. And the larger an apartment complex is, the more likely it is that you'll be the one that's stuck with more utility costs as the investor. Then there's what I call divisibility. What if you've got a property and say that it is underperforming? Well, if you had 10 single-family rentals, you can sell that one of those 10 that's underperforming. But if you have a 10-unit apartment building, well, now you've got to either keep all of the units or sell all of the units. It's not divisible. You can't level up and improve the quality of your portfolio as easily that way. Now, how about something like fire? Even if you're adequately insured, apartment fires often affect multiple units and families, and with a single-family rental, this risk is mitigated. A fire would stay confined to just one unit more often. In an apartment building, disturbances can be bad. One noisy tenant can disrupt and alienate multiple families or make them want to move because, again, apartments attract lower quality tenants. So you do also have more disturbances and more consequences then for them. Financing is a big one. Income single-family rentals have both lower mortgage interest rates and typically lower down payment requirements for you than apartments do. A husband and wife can each get 10 single-family rental loans, so 20 total at the very best rates and terms through Fannie Mae and Freddie Mac with just 20% down payments. And actually above that, there are pretty decent financing options once those first 20 loans are exhausted with a company like Ridge Lending Group. And apartments rarely, if ever, have 30-year fixed-rate terms like what you're going to get with a single-family rental. And then there's vacancy rate. Now, it is true that if your single-family rental is vacant, well, then your vacancy rate is 100% if you only have one of them. And if you had a fourplex instead and it had one vacancy, well, then your vacancy rate is only 25%. But just keep in mind that the same thing is true if you own 4 single-family rentals and one is vacant. There's management to think about. If you hire professional management, your manager would likely rather deal with single-family dwellers. If you're self-managing, which is something I hope that you don't do for long, this is a demographic that you would probably rather handle as well. There's supply and demand to think about. Today, contractors are building many new apartments, and they rarely build the low-cost single-family rentals that are the best ones and the most profitable ones, although that's turned the corner somewhat with these build-to-rent communities. Single-family rental demand vastly exceeds supply in a lot of markets. Market risk is an overlooked criterion. You've got to keep your rentals filled with rent-paying tenants that have jobs. That's just basic stuff. Well, if you think you'll be able to buy 10 rental units in the near future, well, then a 10-unit apartment building, that's only going to be in one location, and that leaves you exposed to just one metro market's economic fortunes. Those people in that market all need to have jobs. But instead, if you had 10 single-family rentals, you can spread them out. Now you can have 4 in Birmingham, 3 in Tampa, and 3 in Indiana. I think you know that national single-family rental property and relationships with property management firms can be found at greturnkey.com. That's where you can find a lot of the best properties at greturnkey.com. You've got to think about your exit strategy. Successful investors begin with the end in mind. Years down the road, when it's time for you to sell your income property, hopefully after years of handsome profits, there will be a much greater buyer pool for your single-family rental than for your apartment building. First of all, more buyers can afford the lower price, and unlike apartments, you even have access to a pool of buyers that might want to occupy that single-family home themselves. Your buyer family, they don't need to make the cash-on-cash return work. After all, they probably wouldn't even know what that means. So those are just some of the advantages of single-family rentals over apartments. And hey, I could go rattle off some advantages for apartments too. A lot of sources, including the Urban Institute, reported that single-family rentals, either detached homes or townhomes, are developing faster than any other portion of the housing market. We have more maturity in the real estate market today. Single-family rentals are beginning to grow up, and we're going to talk about that today. Today's guest, since he represents a company with a national property management footprint, he might even be a great backup manager option for you if your current property manager ever drops the ball. I'm bringing you today's show from beautiful and pristine Anchorage, Alaska. Next week, I'll be bringing you the show from Canton, Ohio. Canton is about an hour south of Cleveland. Of course, the home of the Pro Football Hall of Fame is where I'll be. The following week, couple weeks, I'll be bringing you the show from Pennsylvania. And after that, I'll be in Tampa, Florida, meeting you in person at our Tampa real estate field trip. Hopefully by now, you've signed up for the event at realestatefieldtrip.com. We'll be based at the Hyatt Place Hotel in St. Petersburg, Florida. And we'll be looking at a lot of, single-family rental homes, much like the ones we're discussing today. Again, that's realestatefieldtrip.com. Let's discuss the state of the single-family rental industry today. Today's guest is the Senior VP of Portfolio Services at a leading property management and investment company, Renters Warehouse. You've probably heard of them because they're America's largest company in the management of single-family rental homes, managing more than $4 billion in rental real estate. Award-winning and Morningstar rated, they now manage over 22,000 homes nationwide for investors in 25 states and growing. He earned his Illinois real estate broker's license back in 2002. And then it was really the aftermath of the recession in 2012 that led him to realize that honing in on single-family rental markets was the place to be. And today he speaks on behalf of the real estate industry at high-profile conferences nationwide. Welcome to Get Rich Education, Noel Christopher.
Hi, great to be here. I'm very grateful.
Like me, Noel is also a contributing writer to Forbes. And Noel, you recently published an article that caught my attention about how the mid-size investor is becoming more involved in the single-family rental space today. And you define mid-size as an investor who owns between 25 and 2,000 rental units, which is interesting because I myself own between 25 and 2,000 rental units, and I'm an active buyer of rental single-family homes. So there you go. Look no further than me. Tell us more about the article.
So, the reason I wrote this article is that there's been so much about the single-family rental space, which is quite honestly dominated by what we would call mom and pop investors that own 1 to 5 homes.
Yeah.
And that is the bulk of the space. But what a lot of those investors aren't realizing is that this space, since 2012, has gone through a huge transformation and it's being institutionalized. And what I mean by institutionalized is that there's institutional funds invested into the space, bought up a couple 100,000 homes, which is a small compared to the 16 million single-family rental homes that are out there that are mostly owned by investors who own 1 or 2 homes. They bought up a lot of these homes. They created debt products to service this. They created a marketplace to trade the loans and securitize the debt. And then companies like ourselves have come up to really start servicing, not necessarily just to service the large institutional investors, but to service that small investor, but where they're cutting their teeth. And where I cut my teeth in this industry was servicing those larger investors. And then those efficiencies and savings, which thus increases the ROI of an investor, get passed down to the smaller investor.
So we're talking about big companies like Blackstone that were buying up tons of single-family homes shortly after the crisis.
So I worked with Blackstone in Chicago. We did close to 1,000 homes there, plus a lot of other investors in Chicago that I represented. And so that space is being institutionalized. It's creating more opportunities for the smaller investor to own more homes, create wealth. Now there's marketplaces to buy and sell, which is creating liquidity into the space. So you've got liquidity on the loan market. You're starting to get liquidity in the buying and selling. So now you can go and you have a place that you can trade your rentals. You can put it out there. You can sell it. You can buy rentals in another area. You can diversify yourself more because the disruption in the real estate space are making it easier to transact in multiple geographies. There's efficiencies in the property management. So now you don't need to own a lot of homes in one area. You can own a few homes in a lot of different areas. You're really diversifying what you're doing, and you can really start to pick and choose. And just in the last couple of years, now it's really being opened up to the top 100 markets or more. So now you can invest anywhere in the country and have some confidence of certain aspects of your investment are being taken care of. And this isn't just going through a turnkey investor. You can invest a lot of different ways.
MarketWatch reported this past summer that it's not the big financial institutions that are buying as much as they had been. So some of these large companies had bought a lot of the single-family homes shortly after the downturn, but now large investor share has declined from 24% in 2013, which is where we were still in the aftermath of the crisis, to under 16% last year. So yeah, it is more of these mom and pop landlords that have pushed the investor share of single family home prices to a 19-year high. And for starter homes, which are typically these lower cost homes where the numbers really work, investors now account for more than 1 out of 5 of these type of transactions. And they usually are concentrated more east of the Mississippi because that's where you do have some of the lower priced areas, better cash flowing areas. There tend to be more of those east of the Mississippi River than west. But a lot of times, like you touched on, it's not necessarily where you live. And one needs to be more comfortable investing on a market to take advantage of this.
Absolutely. You hit the nail on the head. And look, there is a need for housing. There's a lot of talk about affordability. I think one thing in that article that it did touch on, the theory is that these investors are keeping the first-time home buyers from buying starter homes. I don't think that's really true at all. A lot of these starter homes are ripe for renters. There's a lot more people renting these days. There's a lot more millennials that are renting that are coming into the marketplace that might move to a lot of these secondary ancillary markets, and they might not be able to afford the house they want. Doesn't mean they can't afford a house, but they may not be able to afford the house they want. So I really look at it as an expectation issue on the affordability. But we're finding that we have a lot of tenants who are choosing to rent and also choosing to invest into real estate because where they live or where they rent, they can't afford the house they want, but they can't afford an investment property somewhere else in a lower cost market. And so that's really interesting as well.
It is interesting. A lot of times, especially if one lives in a higher cost market, it makes more sense for them to be a renter of their own home and exploit some arbitrage and go into the Midwest and South where you can get those better numbers and own homes that you rent to others.
Absolutely. And it's a mindset. So do you want to over leverage yourself and have nothing left over to invest? Or do you want to pull it back a little bit, maybe rent something that's more affordable and then put your extra money into investing and create wealth and own the house you want to live in 10 years rather than owe the bank? So it's really a mindset.
So a lot of it does come down to one, being comfortable investing out of market. And it seems like mindsets around this have changed. Now, I know there are still people that aren't used to investing across state lines. It just seems like in the past, I used to hear these little rules of thumb like, well, you should own property that's within 15 minutes of you so you can easily drive to it. Then it became an hour. And then I heard people say one state away. In the distant past, Noel, I've even heard an investor say, they want to be within just one plane flight of their property. They don't want to have any layovers. In case there's a fire, they can get there in a few hours. I mean, what would that investor do? Help the fire company put out the fire and hold on to a hose? So I don't really understand.
Again, we've said it a couple of times here. It's about mindset. So the mindset used to be that you needed to keep an eye on your investment. It's a big investment. For many people, this is the single biggest investment that they have, whether they own one property, they own 10, they own 20. So the comfort level of knowing and understanding and believing that it's being taken care of properly is what gets you there. So if you are comfortable with your property management and you're comfortable with the back end operations of your portfolio, then you're going to be more comfortable in investing out of your local geographic area. And what's interesting now is that you've got companies like ourselves and others that have popped up that you can now own properties in 5 markets and have the same property manager. The amount of time you spend on in your investment has gone down. So now you can start to go out and look at buying investments in other areas because we have a lot of issues with affordability and prices, and yields have been compressed in many areas. So if you have efficient operations, that's going to help you with your yields and it's going to let you spend more time on finding the right investment.
Well, you bring up something so interesting since Renters Warehouse is a company where one investor can have that advantage of being geographically diversified, but yet just have one owner portal and have just one management company like a Renters Warehouse that serves 25 states. That creates a lot of efficiencies for the investor. How does that work when a company like Renters Warehouse has to work across state lines? So you have some thoughts about dealing with those interstate differences. Of course, states have widely varying landlord-tenant laws. And then in some markets, there are just things like, well, it's customary for the owner to supply the refrigerator in the home. And then sometimes a tenant needs to do that. So how do you deal with that and make that more uniform for the investor?
Even take it a step further, within a city, there might be several different types of, if you're in a large city like Chicago, for example, you have multiple villages. Many of them have different types of rental regulations. Then you have an overall regulation in the county, and then you might have a different county. So we have local teams in all of our markets that are supported by our corporate office. We used to be a franchisor, but we've bought back most of our franchises and we centrally manage and operate our offices with the staff that we need in the local office that know the local markets, that know the local rules, and they can deal with that stuff on the ground with our centralized office that really focuses on supporting and back office. So all that stuff, when you walk into our property management company, you see all those people moving around, doing stuff, processing things. When you walk into one of our offices, you don't see that because that's all happening in our central office, leaving the local office the time and energy to focus on managing the properties locally, dealing with the local municipalities, and all of those things.
These are some of the efficiencies that makes it easier for the mid-size investor. That might be you, the listener, or that might be where you're looking to go. That's got between 25 and 2,000 units. But there needs to be a market for this. So when we come back, we're going to talk more about the single-family rental market. You're listening to Get Rich Education. Our guest is Noel Christopher. More when we come back. I'm your host, Keith Weinhold.
Would you like to know the easiest way to create wealth and passive income with real estate? This is Marco Santarelli with Norada Real Estate Investments. Now you can access the best deals without the stress or hassle of having to find, renovate, or manage those properties. We save you time by providing you with passive income investment properties in some of the best U.S. markets. Learn more by downloading your free copy of The Ultimate Guide to Passive Real Estate Investing. There's no obligation and nothing to buy. Simply visit passiverealestateguide.com and get your free copy today. That's passiverealestateguide.com.
For a real estate investor like you seeking an income property loan, go to Ridge Lending Group, NMLS 42056. Over the years, you've heard President Chaley Ridge generously devote her time to you here on the show as a guest. Ridge provides investment property loans in most U.S. states, and you're going to find out how they've helped more people realize their dreams of real estate financial freedom than any other mortgage lender in the entire nation when you get started at ridgelendinggroup.com.
This is the Millionaire Minds T. Harbecker. You're listening to the powerful Get Rich Education with Keith Weinhold. Don't quit your daydream.
You're back in that abundant place where financially free beats debt free. This is Get Rich Education. I'm your host, Keith Weinhold. We're talking with Noel Christopher from Renters Warehouse about the state of the single-family rental industry. Noel, I think with any investment, it comes down to the economics 101 of supply versus demand. Where's the demand for single-family rentals coming from? Well, it really comes from most millennials and baby boomers. I mean, a baby boomer might be a 71-year-old retiree that worked for 40 years as a West Virginia coal miner, and they might now want to live in a single-family home, not a shared apartment, because they want more privacy, because that's what they're used to from when they were working. But yet that person doesn't want the hassles of being a homeowner and have to do things like clean out the grass from the bottom of the lawnmower or spend time at Home Depot on the weekend. So just talk to us more about the demand side before you talk about the supply side of rental single-family homes.
Sure. On that demand side, I mean, you're exactly correct. So you've got a lot of baby boomers. They're not looking to move into the sprawling suburban type single family rental. A lot of them move into some communities, single family rental communities that are what we call garden homes, very low upkeep, but they've got a little backyard, a little front yard. They can have their dog. They can walk around the neighborhood. They have a lot of great amenities to live in, as well as flip that right back to millennials. And it's the same concept. And it's very interesting how this is happening. The millennials aren't as interested in moving into a 3,000 square foot home in the suburbs.
Right.
They want to live, they're more about, and what we're seeing is they're more about the experience, which I think is good. The hard side is there's not a lot of savings. There's a lot of debt, student loan debt, credit card debt, car debt, things like that, which is a whole different subject. So there's demand there. And then there's a lot of people just can't afford to live or that choose to rent because they want to be mobile or they want to live in a house that they probably couldn't afford if they wanted to buy it. And I see that a ton. And since remote working has become very popular and become mainstream, people can live anywhere in the world, anywhere in the country, and live in rental houses. And so demand for those, and it's tough for apartments to keep up with that type of a demand because you're in an area and you're looking at a nice apartment building or living in a house. Most people are going to choose a house, especially if they've got kids or they're a little bit older.
100%. So the demand side is certainly there from both boomers and millennials. And boomers and millennials also happen to be the two largest age cohorts, the two largest generations alive. Tell us about the supply side of rental single-family homes now that we've talked about demand.
Well, so that's where it's interesting because there is a lack of supply for housing overall in the country right now. And there's a lot of different reasons. You've got cost of labor, cost of materials, cost of land, and then a lot of regulations in a lot of the larger metropolitan areas. There's a lot of regulations. It's really tough to build.
Yeah.
There's a lot of impact fees and all these types of fees. And it's actually hurting some of the larger metropolitan areas. And if you look at the migration patterns of millennials, they're moving to tertiary, secondary markets. And They're moving to a lot of markets that have opened themselves up to business. There's been an influx of companies moving to these areas because of the low cost of living there. And millennials are moving there. There's jobs there, and there's a huge demand. I've seen a lot of stuff written about how, look where these millennials are moving. 42% or more of the homes right now being bought are by millennials. Well, if people are moving there to buy, then people are also moving there to rent because not everybody can buy. So that supply is coming from a couple of different places. Just as homes are getting turned on the market, some of them turn into rentals, some of them stay as owner-occupied homes. And then what's really blown up recently is what we call build for rent.
Right.
Either scattered site, meaning builders are going in, they're buying homes and buying lots and building them throughout neighborhoods, and their new construction, and they're renting them out, or their whole communities. And that's a really interesting concept because you get these whole communities and this is really fueling what we first were talking about, the mid-size investor. You're building these entire communities. They have all these great amenities that you would have in a nice apartment complex, except you're living in a house. And this is much easier for multifamily funds, multifamily buyers to get into the space because they can understand the concentrated homes in one area, and it's easier to manage. You have lower expense ratios than a scattered site portfolio. But they're both areas that are blowing up. I mean, I think there's going to be over 150,000 build to rent homes built this year. And that is something interesting to think about.
And there sure are efficiencies of management with those communities as well, where you don't have the sporadic infill rental single-family home at the same time. Is there any particular advice that you would give to someone that's brand new and is thinking about becoming a new investor in rental single-family homes? What are your thoughts there?
So it used to be that if you wanted to invest into investment property, you needed to find a facilitator. Maybe it was an investment club you paid into. It was a turnkey company that you had to find that would kind of walk you through that process. You don't have to necessarily do that anymore. There's so much knowledge and education out there that's being given away for free, just like yourself here on this podcast, that you can now go into markets, you can find a home to buy and invest, and you can have the comfort about doing it. So you need to do your homework. You need to look at the numbers. A lot of the great deals in the bigger cities are in the fringe areas, and you have to be careful with that. You need to understand that if it's something says it's got a 15% return, that isn't realistic. Now, those kinds of returns can happen, but usually you're talking between 6 and 8%. That's kind of where it is, and you should be happy with that. So don't go into it thinking that you're going to hit a home run, because those can come if you own several homes over time. You're going to hit some home runs there, but go for the base hits. My advice is always, especially in your first 5 years of owning rentals, don't do it for the cash flow, the initial cash flow. Take that money and put it back into the property, pay it down, have a good reserve. And if you're a new investor and you're buying your first home and you need that cash flow to survive, it's probably not a good idea. Really think about what you're doing and understand that beyond the cash flow, you're getting appreciation, you're paying down your loan, you're doing all of those things. And so at 5 years, it gets really interesting. And so get through those 5 years and really focus on cultivating that investment, understanding the home or homes that you own, and making sure that you're taking care of them so that they will pay dividends down the road.
Yeah, paying down extra principal is certainly one way to approach it. There certainly are different schools of thought there on that one. But yeah, it comes down to the fact that really the market is more important than the property, and your team, especially that manager, is actually more important than the property itself. If you don't have your market and your team right, you really shouldn't even be looking at property at all. So with that in mind, Renters Warehouse, you're a large real estate firm that offers property management services. Tell us about what markets you manage in, Noel, because you might be a good backup manager for someone that's currently with a turnkey provider and maybe they're a bit disgruntled with management. And I know you don't currently operate in some of those markets like New York and California that are disadvantageous for cash flow, but tell us where you're at geographically.
Well, so the best thing is, you go to renterswarehouse.com and look at locations. We're in 25 states, 41 markets. It's a lot of the investor-friendly markets, places like Texas, Arizona, Seattle, Denver, Minneapolis, where we're based out of, Chicago, a lot in the Midwest, the Southeast, Atlanta, in Georgia, and Alabama, and Oklahoma, and Florida, and the Charlottes and Raleighs of the world, and all of those areas are a lot of good investment areas. And we're opening new markets all the time. And in addition, in all these markets, we have a marketplace that you can go and buy and sell investment properties. So we have a lot of our owners. We have 14,000 owners that we manage for. now have a place to go where they can sell their properties and buy another property in another market. Or if they live in a high cost market and it's shot way up like a Seattle, some of the investors there are selling their properties and then buying properties in Florida. Now you have places to go to find an investment property, and you have a place to go to sell an investment property, because previously, if you go to a realtor, they'll tell you need to vacate the home and sell it to an owner-occupied buyer. Now, sometimes that might be a good idea because value's gone up so high, but you lose about 8 to 10% in doing that kind of a transaction. So many times it's better to sell it tenanted, and you can start trading properties and looking at other areas. So that's always very interesting.
Right. Well, Noel, thanks so much for coming on here and talking to us more about the state of the single family rental industry.
You look me up on LinkedIn, it's probably the best place to find me. I put a lot of content out there too about investing in the real estate market. Our company is an open book like this. So we love to educate and enable investors to buy more properties.
Noel, it's been great having you here on the show.
I really appreciate it. Thank you.
Yeah, always good to talk to someone like Noel that knows his way around and really understands the single family rental space. Post-interview, Noel brought up the point that in a recession, apartment rents tend to fall more than single-family rents, and that overall, single-family rents are more stable than apartments. My take is that it's pretty likely that you have lived in a single-family home at some point in your life, so you do have this contextual familiarity with how they operate. Apartments operate more like businesses. There are more operations to understand there. In single-family rentals, I tend to like the product type that serves a working class demographic, much like we discussed here last week. Oftentimes, these older properties work well as long as they were well built. And there's a negative supply of these. They tear them down, but they don't build new ones. And you know, it's interesting. With some commodities, say a barrel of oil, for example, if the price of that barrel of oil goes up 20%, well, oil will still perform in lubricating a car engine or forming plastics. It still performs in that way that oil was intended to perform in the marketplace at any price. But now, if a turnkey or a single-family provider prices their property too high, well, then it won't cash flow. So, unlike the oil, which still performs the same at any price, property won't perform for you if the price is too high because it wouldn't produce residual income for you any longer. So there's kind of a built-in pricing fail-safe there with these properties to some extent. You've got a great advantage if you can capably invest out of market, unless you happen to be one of those rare people that lives in a market where the numbers really work. Those people of the old school mindset of only investing locally, they're likely to have less margin because they've limited the pool of properties that they'll buy. There's no cash flow, or the only way that they'd have cash flow is that they've lost leverage. When you invest locally and you have no margin, you're more likely to do things like skimp on maintenance. If the tenant tells you there's no hot water in the shower, you might even be less incentivized to have the repairs be made if you're not profitable on it anyway. Because some people only invest in their local market, today there are tons of people that are actually self-managing a property with less profit when they could be using a professional manager, and even after paying that manager, have more profit. That's because they've bought in an investor-advantaged area off in the Midwest and South. If a home costs over $250,000, then be a renter and pay rent to a landlord. If a property costs under $250,000, own your home and own more homes like them and rent those to others. Now, of course, when I make a statement that's that general, there's bound to be a number of exceptions to it. But I think, as you know from listening here, it's those lower price points that demand more rent income as a percentage of the purchase price. Too much wealth on the coasts drives up those overall markets, and rents don't keep up proportionally. Still today, you can get close to the 1% rent-to-value ratio in a lot of markets. Yes, the inventory is thinner, but just consider, if you have a $1 million California property that you're renting out to someone else for only $4,500, then it's like you're losing $5,500 every month. Because if you own $1 million in rental property, that should generate close to $10,000 of monthly rent income. That's that 1% ratio. So be savvy and exploit the arbitrage. Coming up on the show, we're going to discuss what's become one of the most lucrative real asset niches that we've never discussed before. And at this point, you might be wondering why I haven't discussed it yet. And it's just because I haven't met someone that I knew and trusted in the space until now. It was great to talk single-family rentals today. I hope that you learned something. I'm your host, Keith Weinhold, and I'll faithfully return next week to help you build your wealth. Though you might quit your day job, don't quit your daydream.
Nothing on this show should be considered specific, personal, or professional advice. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Get Rich Education, LLC exclusively.
The preceding program was brought to you by your home for wealth building, GetRichEducation.com.